Hey Tony, thanks for joining me today. It's been a real interesting year. We're getting really close to year end, and I think one of the major topics for the year has been interest rates. Do you see interest rates going up again this year? And what do you see happening in 2024?
So the good news is we think that the Fed is done with interest rate hikes. It's possible there's another interest rate hike, but we really don't think that these interest rate hikes are the key drivers of markets like it really has been in the last 18 months. I think you're right to highlight that the focus will turn to 2024, and the markets are expecting a number of interest rate cuts in 2024. Our view leans a little bit more to the view that global economy is looking resilient, and therefore we don't necessarily will get a lot of benefit from interest rate cuts. I think in the end, our view is we may see a couple of interest rate cuts in 2024, but probably less than what the market's expecting.
Thanks, Tony. So given this outlook, is it time for clients to start moving away from deposits and bonds? It's been attractive yields, but is it time to start thinking about equities?
Yeah, I think investors should be looking more at equities this year. I'm sympathetic that investors saw a lot of volatility and downside in equities last year, and that this year, most economists around the world were forecasting a recession, so I can understand why many investors are still cautious. But since the start of the year, we've been highlighting that the valuations improved after the correction last year, and that our view on the economic downside is that we just see a mere slowdown without too much pain. And therefore, since the start of the year, we've been recommending investors stop underweighting equities, get back to more normal levels.
That's good. That sounds exciting. So within that equity space, and we're moving into a potentially overweight view, where are the structural opportunities that you see, especially for mid to long-term investors?
There's a few regions that we think there's some interesting long-term structural stories that are building. And so in particular, we've been highlighting the opportunity in ASEAN and the opportunities in Japan. And firstly, then maybe for Japan, we highlight that, this bout of inflation that's been so problematic for most parts of the world is actually a benefit to Japan in terms of breaking out of their deflationary ruts. Additionally, Japan has been more focused on becoming more efficient with the regards to shareholder value. Their valuations have improved, and they still have many businesses that are very competitive, both domestically and internationally. We think that's all adding up well for Japan. And then in ASEAN, we continue to highlight that ASEAN has a really big consumer base that makes it interesting to invest there and is becoming less just tied to whatever's happening in China and the US. Additionally, I think as the world has tried to diversify from doing all its building in China, ASEAN has been one of the main beneficiaries.
China seems to be a real big question with a lot of investors. Does it represent a key part of their portfolio still? Does it represent long-term value? What's our views on China?
So we're still underweight China, and China has been very disappointing this year. Everyone was so optimistic as they were reopening at the beginning of the year that it should lead to strong benefits to the Chinese market. It's been hard to see evidence of this. The economic data has been much weaker than expected, and structurally there are concerns about what is their engine of growth if they can't depend on property as much. When China has rebounded in the past, their markets have performed well, so we continue to keep an eye out for it. But we don't necessarily think it's fourth quarter 2023. We suspect maybe the opportunity will be in 2024.
So Tony, given our views on equities, what about bonds? So generally most clients are short duration, high quality. Do they change their stance on investing, or and what are our thoughts on those?
I know fixed income managers are looking at the bond markets and they're seeing really attractive yields. They see in investment grade, good quality bonds where they can get 5 to 6% yields, and in the higher yield space that takes on more risk, but you're seeing yields that could be 7 to 8%. Well, I think diversification is the name of the game here, and having a little bit of each is going to be helpful.
So Tony, when we think about things a little bit longer, we've been having these conversations with clients, especially for clients who are looking for investments for the next 3, the next 5 years. Do we go back to an environment pre-COVID where growth is good, or do we go back to a different kind of environment? What is our thoughts and views, and where do we see this going?
Yeah, so we do think this higher for longer theme is a real important issue for markets, not only this year, but really for many years to come. The interest rates that the economies have operated at in the last decade were very low, and they're shifting to a much higher level. And we think there's a lot of growing evidence that that's happening. And it has implications for all the asset classes, not necessarily negative for everything, but it's an important issue in terms of how we think about diversifying our investments. So I think you're right. Internally, we're doing a lot of conversations about this topic, and I think it's something increasingly investors and ourselves should be discussing.